Welcome to part one of a three-part English masterclass on government finance and inequality. In this video, we focus on the most basic and most important tool the government uses to manage the economy, the state budget. We will see why government economic management matters at all. We will dissect the structure of the state budget, its revenue side and its expense side. We will look at the categories of government revenue and the categories of government spending. We will define what it means for a budget to be balanced. And by the end of this video, we will introduce the foundational concept of the budget deficit. What happens when government expenses exceed revenues, which is the topic we will explore in depth in part 2. Let us begin. Section 1. Why government economic policy matters. In any modern economy, the government plays a massive role. It collects taxes. It pays wages to public employees. It buys goods and services for public administration. It builds infrastructure. It runs schools and hospitals. It provides pensions and unemployment benefits. Together, all of these activities make the government the largest single economic actor in almost every country. In a typical developed economy, the government accounts for 30 to 50% of total economic activity. This scale gives the government enormous power. Its decisions affect inflation, employment, growth, distribution, and stability. How the government manages this power, how it spends, what it taxes, how it borrows, is the central question of fiscal policy. And the operational tool through which fiscal policy is conducted is the state budget. The state budget is where the entire fiscal apparatus comes together in a single document, voted on each year, scrutinized by every political faction, and watched by every market participant. Section 2. The structure of the state budget. The state budget has two main parts. Revenues, what the government earns or collects, and expenses, what the government spends. This sounds simple, and at the most basic level it is. Every dollar the government takes in counts as revenue. Every dollar the government pays out counts as expense. The sum of all revenues, balanced against the sum of all expenses, determines the budget position, surplus, balance, or deficit. This is exactly analogous to the budget of a household or a firm. The key insight is that the government, like any economic actor, must balance its books over time. It can run a deficit for a year or several years. But persistent deficits accumulate into national debt, and debt service eventually becomes a constraint. The budget is the document where this whole conversation happens. Section 3. The revenue side. Where does the government get its money? The vast majority comes from taxes. Income tax, the tax on what households earn. Corporate tax, the tax on business profits. Value-added tax or sales tax, the tax on consumption. Property tax, the tax on real estate. Customs duties, tax on imports. Excise taxes, specific taxes on tobacco, alcohol, fuel, luxury goods. Together, these account for the bulk of government revenue. In a typical developed economy, total tax revenue is between 30 and 40% of GDP. Some Northern European countries collect even more, up to 50% of GDP. Beyond taxes, the government has non-tax revenue. Fees and charges for public services, passport fees, licensing fees, court fees, fines and penalties, traffic tickets, regulatory penalties, dividends from state-owned enterprises, earnings paid back to the Treasury, royalties from natural resources, oil revenues, gas revenues, mineral royalties. These non-tax sources are smaller than tax revenue in most countries, but in resource-rich economies, they can be significant. Section 4. The expense side. What does the government spend money on? The biggest category in most countries is wages and salaries of public employees, teachers, healthcare workers, military personnel, police, civil servants. This is one of the largest single line items in any government budget. The second major category is purchases of goods and services for government operations, supplies for schools and hospitals, road maintenance, military procurement, office expenses. The third category is transfer payments, pensions, unemployment benefits, welfare, child allowances. Transfer payments do not represent new production. They are simply redistribution of existing income. The fourth category is investment, building new highways, new schools, new hospitals, new infrastructure. This expands the country's productive capacity. The fifth category is interest payments on the national debt. As debt accumulates, the interest cost grows, and in some heavily indebted countries, interest payments can become the single largest line item in the budget. Each of these categories has different economic effects. Wages and salaries directly support employment. Purchases stimulate domestic production. Transfers go directly to household incomes. Investment expands long-run capacity. Interest payments reward bondholders. Section 5. The mathematical definition. Let us put this together formally. Let T denote total tax revenue. Let G denote total government expense, both consumption and investment. The budget balance is T minus G. If T equals G, the budget is balanced. If T is greater than G, we have a budget surplus. The government collected more than it spent. If T is less than G, we have a budget deficit. The government spent more than it collected. These three outcomes correspond to three different economic situations. A balanced budget is fiscally neutral. The government extracts what it spends. A surplus means the government is net withdrawing money from the economy. A deficit means the government is net adding money to the economy by borrowing the difference, typically through bond issuance. The relationship between these outcomes and macroeconomic policy is central to all of modern macroeconomics. Fiscal expansion typically means running a deficit. Fiscal tightening typically means running a surplus. Both have different effects on output, inflation, employment, and the trade balance. Section 6. A simple worked example. Suppose a small economy has the following budget. Total tax revenue T equals 100 billion. Total government spending G equals 120 billion. The budget balance is T minus G. 100 minus 120 equals negative 20 billion. The government has a deficit of 20 billion. How does it cover the gap? By issuing bonds. The Treasury sells 20 billion in bonds to investors. Those investors hand over 20 billion in cash. The government uses that cash to fund the spending. The bonds are an IOU, a promise by the government to pay back the 20 billion with interest at some future date. The accumulation of these IOUs, year after year, is what becomes the national debt. So budget deficits and national debt are linked by accounting. Every dollar of deficit must be funded by a dollar of new borrowing, and every dollar of new borrowing adds to the national debt. Section 7. The budget as economic policy. The state budget is not just an accounting exercise. It is the most powerful instrument of economic policy. Through the budget, the government can stimulate the economy by spending more or by cutting taxes. It can cool an overheating economy by spending less or by raising taxes. It can redistribute income by changing the tax structure or by expanding transfer payments. It can shape the long-run capacity of the economy through investment in infrastructure, education, and research. Every year, when the budget comes up for a vote, all of these levers are being adjusted. Different political parties advocate for different positions. The poor want more transfers. The wealthy want lower taxes. Businesses want better infrastructure. Pensioners want larger pensions. Every constituency has its preferred budget shape. The actual budget that emerges is a political compromise. But the economic effects of that compromise on growth, on inflation, on debt, are determined by basic budget arithmetic. T minus G. That single relationship drives everything else. Section 8. Introducing the deficit, coming in Part 2. When T is less than G, we have a deficit. This is the most consequential situation in fiscal policy, and it is the subject of Part 2 of this series. We will see how the deficit is measured, not just in absolute terms, but as a percentage of GDP. We will see why economists distinguish between primary deficits, which exclude interest payments, and structural deficits, which adjust for the business cycle. We will see the connection between deficits and national debt, and how persistent deficits can become unsustainable. We will examine credit ratings and what they tell us about a government's ability to service its debt. And we will see why the Maastricht criteria, the European Union's fiscal rules, chose 3% of GDP as the limit for deficits and 60% of GDP as the limit for debt. These are not arbitrary numbers. They reflect the threshold above which fiscal mathematics starts to break down. Conclusion. In this video, we have built the foundations of fiscal policy. We have seen why the government's economic role is so consequential. We have laid out the structure of the state budget, revenues, and expenses. We have seen the categories of government income, taxes, and non-tax sources. We have seen the categories of government spending, wages, purchases, transfers, investment, interest. We have written down the budget balance equation, T minus G, and seen how it gives us surplus, balance, or deficit. We have walked through a numerical example. We have understood that the budget is the most powerful tool of economic policy. And we have introduced the concept of the deficit, which is the focus of Part 2. If you found this part useful, please share the video with someone who would benefit. And subscribe to Macroeconomics with Michael for Parts 2 and 3 of the series, on deficits and debt sustainability in Part 2, and on income inequality in Part 3.